Journal entries in accounting. Journal entries represent the very first step in the accounting cycle where financial transactions are formally recorded. Think of a journal as the business's financial diary, where each transaction gets its initial entry before being categorized further. A key feature of the journal is that it provides a chronological log. All transactions are recorded sequentially based on the date they occurred. This creates a historical timeline of all the financial activities of the business. The primary purpose of creating a journal entry is to capture all the essential details and the full financial impact of a business transaction in one place. This systematic recording happens before the information is transferred or posted to the individual accounts in the general ledger. Understanding the double entry system. Journal entries are built upon the foundation of the double entry system. This fundamental accounting principle dictates that every single financial transaction has dual effects and must impact at least two different accounts within the accounting system. For example, buying equipment with cash affects both the equipment account and the cash account. A critical rule of the double entry system, applied rigorously in every journal entry, is that the total monetary value of the accounts being debited must precisely equal the total monetary value of the accounts being credited for that transaction. This equality, debits must equal credits, ensures that the fundamental accounting equation, assets equal liabilities plus equity, always remains in balance. Debits and credits. Debits, often abbreviated as DR, increase the balance of certain types of accounts, specifically asset accounts like cash or equipment, and expense accounts like rent or salaries. Debits also increase drawings or dividend accounts. Conventionally, debits are recorded on the left side in accounting T accounts and often listed first in journal entries. A common mnemonic is DED. Debits increase expenses, assets, drawings. Credits, abbreviated as CR, work in the opposite way. They increase the balance of liability accounts such as loans payable or accounts payable, equity accounts like share capital or retained earnings, and revenue accounts like sales revenue or service fees. Credits decrease asset, expense, and drawing dividend accounts. Credits are recorded on the right side in T accounts and typically listed after debits in journal entries. A common mnemonic is CLOR, which stands for credits increase liabilities, owners' equity, revenue. Components of a standard journal entry. Every journal entry must include the specific date on which the business transaction took place. This establishes the chronological order. The entry must clearly identify the specific account or accounts that are being debited. This indicates which accounts are affected according to the debit rules previously discussed. Similarly, the journal entry must identify the specific account or accounts being credited, reflecting the other side of the transaction according to credit rules. Indentation is often used to visually separate credited accounts from debited accounts. The corresponding monetary amounts for both the debits and credits must be recorded. As noted, the total debit amount must equal the total credit amount for the entry. A brief description, sometimes called a narration or memo, is included to explain the business purpose of the transaction. This provides context for anyone reviewing the journal later. Often, a reference number may be included. This could be a unique journal entry identifier, a code linking to a source document like an invoice number, or a posting reference indicating when the entry was transferred to the ledger. Importance of journal entries. Journal entries create a complete and sequential history of all financial transactions. This chronological record is invaluable for tracking activities, auditing, and understanding the flow of business events over time. The requirement that debits must equal credits within each entry acts as a basic error detection mechanism. If an entry does not balance, it signals a mistake that needs correction before proceeding further in the accounting cycle. Journal entries serve as the crucial first step and the primary source of information that is subsequently posted to the general ledger accounts. The balances in the ledger accounts are then used to prepare the key financial statements, such as the balance sheet and income statement. Accurate journal entries are therefore fundamental to reliable financial reporting. To summarize, journal entries are the initial, chronological record of all business financial transactions, forming the first step in the accounting cycle. They are based on the fundamental double entry system, where every transaction affects at least two accounts, and total debits must always equal total credits, ensuring the accounting equation remains balanced. Each entry details the date, accounts debited and credited, amounts, and a description. Accurate journal entries are crucial as they provide a complete historical record, aid in error detection, and form the essential foundation for posting to the general ledger and ultimately preparing reliable financial statements.